Good morning, everybody, and welcome to the Daily Energy Markets Podcast. It is April 1st, 2024. It is 10:30 UAE time, and we have Brent crude oil starting the quarter at $87.25. We did average through Q1 at about $83 on Brent, although we started at a pretty low point around 75, 76, climbed $10+ with the average at around 83. Omar Najia, Global Head of Derivatives at BB Energy. You called it right through the quarter, Omar, growing, higher. What's your call for Q2?
Higher and substantially so. So basically, I think that a lot of people mistake a market that's very overlapping to the upside with a weak one. But like you've said, I think we've moved substantially higher. I think we'll move substantially higher again. So first target will be $90 WTI, then 95, then 120. And nothing moves in a straight line. So we're looking for new all-time highs without a move below the low that we saw early this year, about 67, 65, something like that. Let's call it $67 WTI. So we're looking for new all-time highs, which means above 120, $130. Why? Why? Because we're looking at the price action, not on fundamentals, demand, supply, all the rest of it. And news will come in, and you can fit all this stuff around it, etc., etc. But the trend is higher, as is the trend in gold, as is the trend in the S&P, as is the trend in Bitcoin, and as is the trend in inflation. So, whatever happens, people keep arguing, will the Fed cut? Won't they cut? The Fed need to cut. If inflation increases, they'll cut, and if inflation doesn't increase, they'll also cut. And the reason for their cutting has nothing to do with markets, has to do basically with the amount of debt that they have, which is increasing by about $1 trillion every 100 days in the US, and the affordability of interest rate payments. So they're going to do one of two things. Either basically they inflate their debt away, or they go belly up. So our forecast is they inflate. So higher.
Mark Howson, Head of Asia, Wellington Analytics. Are we seeing higher in China? China's factory activity in March, the cakes in S&P Global China Manufacturing Purchasing Managers Index, Janie Mackers, give me an acronym for that one, please, was at 51.1 in March, strongest since over a year. China may be surprising to the upside. Are we seeing that in LNG and gas demand?
Yeah, very much so, Sean, and thanks again for having me on this week. Chinese LNG demand really surprised everyone on the upside last year. It actually grew by 13% year on year, and it surpassed Japan to be the world's largest LNG importer again, regaining its top slot. Obviously, the reason for that is the demand is recovering for most things in China, particularly natural gas, post the various COVID lockdowns. And it was really that demand increase from China and some other Asian LNG markets that pushed the LNG market higher last year. We had a 3% growth in total LNG demand. European demand was pretty flat year on year. So it was really Asia coming back into the buying activity. And again, it's really that Asian demand why we have these relatively high prices again. In the short space of under a month, we have an over $1 increase in spot LNG prices in Asia to now above $9.50 again. So again, it's just that resumption in Asian demand in combination with some of the factors Omar mentioned. Now, LNG is often a substitute for oil products in some Asian markets. So when the oil price moves upwards, it does drag the LNG price upwards as well.
Gulmira Razayeva, founder and managing director of Eurasia Analytics, one of the top energy analysts in the Caspian region. Gulmira, a tough year for Azerbaijan to be hosting COP29, as we saw all of the noise out of CERAWeek in Houston recently. all the big oil CEOs, oil and gas, NOC, IOC CEOs saying, forget about energy transition. It's all about oil and gas. Your thoughts of how Azerbaijan takes on this challenge in a year when it looks like the oil and gas industry's regained its mojo and is dismissing energy transition?
Well, I think energy transition is losing its meaning because, yeah, definitely, energy transition cannot be happening without oil and gas industry, energy industry, and I mean COP28 showed that the role of energy industry, these energy majors, is tremendous in eliminating greenhouse gases. I mean, if they cause 30% of total emissions, then obviously their role should be quite active in energy transition and also climate change. I think Azerbaijan has a tremendous job to, I mean, this is of course challenge, but also the countries can face a lot of challenges, but also opportunities to bring together all the parties and try to find the ways to encourage them, to find the ways to come to consensus, especially on financing issues, on funding issues, because provision of financing permitted every discussion at COP28 last year, as developing countries underlined that every step they must take needs monetary support from the developed world. The thing is that the issue generated some significant highlights, but also continued to be a source of frustration and lack of trust between the global south and global north. And the good thing here is that I think, encouragingly, the organizers of all three conferences, I mean, COP28, upcoming 29, and also COP30 in Brazil, are now coordinating to ensure continuity of the debate at this critical time. So questions about the efficacy of the COP process and its need for consensus agreement have re-emerged last year at COP29, but are little real consensus consequences given the urgency of the action required. So I think Baku will do every effort to find the ways, not only to make parties to focus on new finance pledges for 2025-2030 period, but also I think we need also to agree in 2024 on more ambitious, NDCs for every country to present, a results to present at COP30.
Yeah, well, it's certainly a fairly big challenge, it would appear. Omar, coming back to the narrative of, the Fed cuts, whether, inflation is up or inflation is down, is that what we're seeing in the gold price? Again, hitting a record today at $2,255, that the gold is telling us that the Fed is going to now ignore inflation.
Right. So basically, the Fed has a problem. The problem is basically that the US is spending money that it doesn't have and is basically insolvent, right? So the debt is growing so massive that it cannot be repaid.
But that is just to be clear, that is not part of the Fed's mandate, right? The Fed mandate is inflation and it has employment. The bankruptcy of the US government, I don't believe, is in its mandate.
Yeah, I mean, it's not in its quote unquote mandate. But then, you have to take things with a pinch of salt. So inflation, the inflation that the Fed is mandated to take a look at, doesn't include energy prices, doesn't include house prices, doesn't include school prices and all the rest of it. So the CPI is massaged, is always changed over time. So you can, whatever, if you think that the Fed is mandated for this and that, but the bottom line is the Fed has a problem because it basically takes care of interest rates and the US dollar. The problem is debt is growing way too much. So if they keep interest rates where they are, they're going to be paying massive amounts in interest payments, which means basically they're going to be borrowing to pay for their borrowing, right? So that situation is basically unsustainable. So what they are going to do is they're going to lower rates, they're going to let inflation increase. And by doing that, they're going to do, it is in the Fed's interest to debase, to lower, to weaken the USD, right? So they owe basically, let's say they owe $100 US. That $100 US is equivalent to one dinner, right? If you can make that $100 US cost be not for a dinner but for a starter, then basically you're inflating your debt away. So the point being, they're going to move interest rates lower. They're going to try and weaken the US dollar. And by weakening the US dollar, they're going to basically stay as competitive as they can, but basically inflate this debt that they have as much as they can. So it doesn't matter what happens with markets, doesn't matter what happens. The entire point is that the US is spending way too much, and there is no politician in the US that can stop that spending. It's $1 trillion every 100 days now. So in 365 days, that's $3.7 trillion in excess debt. That's overspending. Okay, so at the end of the day, the only way you deal with that is by weakening your currency, and everybody needs a weak US dollar. Everybody, including the Fed. So the dollar is going to become weaker and weaker, and it's been going on for 50, 70 years plus, right? So
The trend line
is it's not going to change. And what's interesting is what happens at the end of the day when basically you've done all that, and what happens, and that's what people are talking about, having a global reset. What will emerge instead of the US dollar? Will it be the CBDC backed by something, maybe gold, maybe Bitcoin, who knows? But the US dollar's days are numbered. I don't know if it's 10 years, I don't know if it's 100, I don't know if it's 2. But what I do know is that this kind of stuff is unsustainable. So and that's why you're seeing gold higher. So the weaker the US dollar, the higher gold is real money. Commodities are real tangible assets. Bitcoin is a real tangible asset, and that's what people are buying, and they're giving their paper away.
An ounce of gold was enough to dress a gentleman 1,000 years ago, and an ounce of gold is still just about enough to dress a gentleman today. Mark, looking at the wider Asia outlook, it's so critical to both gas demand and pricing as well as oil. We have the World Bank over the weekend warning of slower growth in East Asia, sort of as a sort of domino effect from China's general malaise. GDP growth seen slowing now to 4.3%, who had previously been forecast at 4.5% this year. How does the rest of Asia look from an energy demand point of view now after Q1 and looking forward to Q2?
Well, you're right to highlight that, Sean, because you're right. Energy demand expectations have come down slightly recently in Asia, but whatever way you cut the kind of, particularly on the gas side, the gas supply demand balances across the region, almost without exception, gas supply is basically domestic production's either plateaued at best, or in most of the countries like Pakistan, like Bangladesh, like Thailand, like certain parts of Malaysia, likewise Indonesia, it is declining. So even if demand stayed flat, which it won't in the Asian countries, though it will continue to grow, there's still this long-term structural deficit in terms of particularly gas supply. And then the question comes to, how do these Asian countries try and fill that supply shortfall? Sadly, they generally can't pipe the gas in between the countries because none of them really have excess supply. And therefore, get the whole upstream sector attracting investments and then finding resource and monetizing the resource, that can take 10 years plus. So it only really leaves a lot of these countries with LNG as the way to meet their gas needs, certainly in the short and medium term. And that is why last year alone, we saw Philippines begin LNG imports, we saw Thailand begin LNG imports, we saw Hong Kong begin LNG imports all for the first time as well. And those countries are just increasingly going to bring in LNG just to keep their gas demand somewhat in balance. So that is very much what we see pushing up prices. And the challenge this year, of course, is there's very little new LNG supply globally hitting the market, just a few relatively small projects in West Africa and also Mexico that are expected to start up. Obviously, the big North American and Qatari supply should get going 2025 and beyond. But we therefore see a tight market again this year, and prices creeping up certainly to over $10 per MMBTU in the summer months in Asia.
Will we see China?
Well,
will we see China sort of surpass its pre-COVID levels and start to reach new heights in terms of LNG demand, LNG imports in 24?
That is certainly very possible, quite frankly, particularly if European demand stays weak. Obviously, European gas demand came off by 20% last year versus 2 years prior, just because of high prices has been destroying demand. If that trend continues and the Europeans aren't able to kind of stem the gas demand destruction, then, like you say, China could potentially go higher than their pre-COVID levels.
Gulmira, how does that play out for Central Asia now? I mean, it's a difficult development outlook for the East Med and the Caspian, given it looks like the US is winning in the LNG supply into Europe. Europe is coming out of winter, I think possibly the first time ever, with storage near full capacity. What do the combination of those factors mean for the outlook of development in Central Asia?
Well, I think one might be forgiven for thinking that after 3 long years, the gas market crisis is over. I think with regards to the major market of the Caspian region, which is the European natural gas market, I think after another mild winter, European stocks are on course to end the heating season at record high of over 64 BCM, reducing volumes that need to be injected this summer for stocks to reach EU mandated target of 90% of capacity by 1st of November. So there is now such a huge pressure on the market now, demand pressure, but I think also the suppliers, including the pipeline supplier as Azerbaijan, they still try to increase, and they've been increasing gas export to Europe for some 2 BCMA of annual contract capacity. So and by 2027, Azerbaijan is planning to double the gas export to Europe. But and you mentioned LNG. I think well, there's kind of a competition between pipe gas and LNG, but we need to pay attention to prices here, because a long-term contract signed with pipeline suppliers, including Azerbaijan, price formation is different, and therefore prices for this gas are lower than LNG price. So also you have supply security here. For instance, Bulgaria pays the lowest price for gas than any other country in Europe. This is because Bulgaria buys some 1 BCMA of gas from Azerbaijan, and this gas price is linked to oil price. That's why the price is quite low. So you can't say the same thing with regards to LNG. But I think with the prospect of another summer of weak demand, benchmark spot prices for gas and LNG in Europe, but also Asia Pacific, have fallen and will be fallen. futures are back to around $9 per MMBTU, and this levels last seen in mid-2021 when the market was still at the start of its climbs towards its August 2022 highs. Prices may slightly yet over the next few months. So, but the declines to date have already started to spur more price-sensitive demand, limiting how much further they could fall.
Let's go to the survey question this morning, which is looking at this outlook for Q2 on Brent. Brent crude oil rose steadily through Q1 to average about $83 per barrel over the quarter. What will it average in Q2? 85 to 90, 80 to 85, 75 to 80, or none of the above? Brent crude oil rose over $10 through Q1 to average at 83 per barrel over the quarter. What will it average in Q2? Place your bets on that one. Looking to Q2, Omar, from the point of view of the annual cycle, the Fed rate, obviously all markets rising, but is there a sort of a Q2 demand where the front month is going to just be elevated because of the annual cycle on the demand side, adding extra sort of upward motion here in terms of US driving, summer driving season and so on, basic old-fashioned fundamentals?
Yeah. I mean, definitely you're going into, as you approach summer and gasoline and all this kind of stuff. But I just saw a story come out now that the US deficit for this year, so the US interest to hit 1.6 trillion by year end, making it the largest US government outlay. So now they're forecasting that the money that they pay, the interest that they pay on their debt, is going to be not a trillion, but 1.6 trillion by the end of this year, which makes it the largest single US government outlay, more than they spend on defense and more than they spend on social security, right? So if the Fed doesn't cut interest rates, you're going to see the weakening US dollar become disorderly. It's going to become like a little bit panicky. So if they cut interest rates, they'll have a chance basically to control that weakening of the dollar. So in any case, we think that, we're going to see all markets move the same as equities, the same as Bitcoin, the same as gold, the same as anything. So and the same as, what Gulmira was talking about, global South and the combined West. The idea being that the Western economies are founded on paper and debt, and the economies of the global South are founded on commodities, on real wealth. So what is going to happen going forward is what happens when, for example, let's say Saudi Arabia says, we're not accepting the dollar anymore. Or the UAE says we're not accepting the US dollar for oil. Then so the natural, what I'm trying to say is not just oil, but commodities in general. There's a massive demand for US dollars from the whole entire world because most commodities are traded in US dollar. If that stops or that gets reduced, then again, you're going to have a massive problem being basically the US. So I'm not telling you that it's happening today. I'm just pointing out that we have a real, like that movie, real present danger that the US dollar could undergo.
Well, we saw it. It was even the budget office within the Congress has issued its own warning and featured on the front page of the Financial Times the other day. So clearly the red lights are flashing in the corridors of power in Washington. Whether anyone listens, of course, is another thing. Mark, regardless of the bigger picture traumas in the US debt, lower interest rates would certainly be welcome in Asia, and one would think add a little bit of support to the economic outlook there. I wonder, would it change anything on the trajectory of Asia's appetite to build and invest in permanent LNG facilities We saw in the previous down cycle in LNG prices, Asia missed that window of opportunity. Now with oil, gas, LNG off again, although upwardly moving, it's still below $10, which has to be some kind of relief in Asia. The outlook for Asia taking the big step to build the permanent LNG infrastructure it needs.
What we see on that, Sean, when we speak to buyers and sellers in the region is they're actually increasingly happy with both floating liquefaction infrastructure and then the floating FSRU, so storage and regasification infrastructure, as opposed to the importers building big onshore facilities, because of course the onshore facilities are higher capex, and it does mean that an importing nation is locked into importing LNG, whereas we've seen the examples of Bangladesh and Pakistan in particular. If you can bring in a floating storage and regasification unit, if then you eventually manage to develop your domestic resources, that floating storage and regasification unit can sail away. It also typically has a lower carbon footprint because, of course, you don't need the whole site clearing and as many onshore storage facilities as an onshore terminal would as well. And as I say, it's a lower capex spend and a quicker payback time as well. And some of these markets, and Australia is an interesting example, it's a highly seasonal market, so they're likely to only need LNG in their peak demand months, in which case it's possible that FSRU could kind of go elsewhere for certain months of the year. So really, importers are increasingly preferring the flexible FSRU lower capex route as opposed to building the large.
I mean, is that principally because
facilities?
Is that principally because they can't access the capital, or it's emerging as a more attractive flexibility trumps?
More the flexibility, Sean, to be honest with you, given how volatile these markets have been the last couple of years.
It certainly have been. Gulmira, just to wrap up on not the easiest question of them all, but nonetheless, the outlook for the war in Ukraine and its ramifications for the European gas markets. Inevitably, the big turn away from Russia, the arrival of US LNG into the European markets. But similarly, the European markets are not investing into permanent LNG import facilities. What's your outlook for the idea of the Russia-Ukraine war finding, if its outlook, it looks like it's, I mean, the concerns are growing that the money isn't going to come in to sustain this war. Does Russia's gas return to the European markets? Where does the implications of a wind down of the Russian-Ukraine conflict impact European gas markets?
Well, I think the big question here is whether the transit contract between Russia and Ukraine will or will not be renewed after end of this year. So as things stand now, it most likely won't be renewed. But I think this will have effect on some countries which are importing gas via the Ukrainian route. That's the mainly Central European countries. So it's like Austria, Slovakia, and other countries. So they will be affected. But I think some measures has been already taken to provide energy security for those countries, and they are able to import gas, although at the moment for very small volumes from the neighboring countries, because again, Europe needs to invest in a connectivity between the countries, because that's the now major issue in Europe. Also gas from Azerbaijan or LNG from the south or from the north, can be flowing to those countries. But the constraint in infrastructure capacity, in interconnectors between the countries, does not allow these countries, to import gas from neighboring countries in a needed amount. So I think this is an issue that European Commission, the Energy Commission, needs to address. And you know, it's that. And another thing, which this brings me to another issue, which is the funding of energy projects. They are not they are not the project of common interest, you know, and the European Commission stopped funding this kind of project. So this is all needs to be funded on a government, you know, national government budget.
Well, we'll have to wrap it up there and look at where we might see oil prices go in the second quarter. We're looking at 85 to 90, sort of a move up from the 80 to 85. We averaged in first quarter at 83, averaging in the second quarter to be in the upper half of the 80s rather than the lower half. Certainly that's where things have started the first quarter this morning, with Brent crude oil trading above $87. It's holding that that sort of breakout that we saw in the second half of March, where we were mostly in the low 80s and have broken out and have marching towards 90, it would appear. We'll have to wait and see tighter OPEC supply cuts, rising inflation of everything. As Omar mentioned, every financial market seems to be hitting a record, including the cuckoo in the coal mine, gold. It's somewhat counterintuitive to everything else, but it tells me that we're all going to have to live with higher inflation. Otherwise, the US government's going to go bankrupt. So that's the reality of 2024, perhaps. Omar Najee, as always, Monday morning isn't the same without you. Thank you so much. And Mark Howson in Singapore, really great to have you back at the table, Mark. And Gulmira Razayeva, as always, in from London, expert from the Caspian. Great to have your insights, Gulmira. Have a great week, everybody. We don't have an April Fool's Day joke, but maybe it's not a day for joking. All the best. Thank you.
Thank you.
Bye-bye.
Bye.